The answer to the second part of this question, is it governed by an ability to find two puts costing less than the sell to open premium? The answer is kind of yes, but it's okay to do this at a debit rather than a credit. How would you manage the position? Well, naturally, we want to look at the structure of the position first before we go into the management. SPY or any stock would do for an example. Fantastic. Let's just stay with SPY, Paul. We're going to go to Power Options, and I'm going to go to the Custom Spread tool to take a look at the Put Ratio Backspread. We did cover this. I was looking for it prior to the webinar, but we did cover this a week or two ago, I believe. We looked at an example of managing and rolling a ratio backspread. I could have sworn it was 2 to 3 weeks ago, but I couldn't find it. Well, with the exception of last week. So it was sometime at the end of July, possibly in August. But I couldn't find the exact description of it, Paul. So I'm going to dig that up for you, because we did discuss a management technique there. All right. Real quick, Betty asked, oh, sorry, let me show my screen. That would help us all, wouldn't it? Fantastic. Betty asked, is this recording? No, this is live, Betty. But it is being recorded, and it will be posted later this weekend, hopefully tomorrow, and you'll have access to the full recording, but likely I'll split this up into 2 separate webinars, so the full hour and 15, hour and a half isn't just compressed into one as I usually do. I've been trying to break them apart to have the topics more separated. Very quickly, before we go to the custom spread tool to analyze Paul's discussion, I just want to remind everyone what you're looking at here, of course, is a view, the standard view of a 14-day free trial. You can take a 14-day free trial to Power Options at any time, no credit card required. If you just got started, make sure you take advantage of the 4 steps. The free quick start guide. We have flash tutorials to help you get familiar with navigating the site, as well as other help videos. We have a variety of free webinars available during the week, and also a vast archive of webinars, again, for the tools, strategies, and more. And of course, anyone who is on a trial or a subscriber for Power Options can schedule one of these free coaching sessions at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have as well. So make sure you take advantage of those 4 steps to help you get really going with the Power Options tools during your trial period. And it never hurts if you're a subscriber just to go back and go through some of the webinars, or just schedule a coaching session to touch base, see where you are, see what tools might be there that you haven't found yet to help with your trading. All right, so one of our tools, of course, is the custom spread tool. It just allows us to build a spread on the fly. We're going to take SPY. Now, the structure we're talking about here, ratio backspread for Paul. We're going to buy 2 puts and sell 1, but we want to do it at a credit. We want the one contract that we're selling to be at a higher premium. So what does that tell us? It tells us we're likely buying 2 out of the money puts, lower strike prices, and selling one that's at or maybe even slightly in the money, depending on our outlook for the position. Trying to do it at a credit, but a small debit is fine. Let's take just a basic structure. One of Paul's first questions is suggestions on expiration to use. Now, normally when I talk about a spread, whether it's a bull put spread, a high probability bull call debit spread, which I think we're going to touch with the next question that came in, or even a calendar spread or an iron condor, I typically look to be 14 days out in time. Those are related to collecting a credit. But in this ratio backspread, even if you collect a credit, you're not so much focused, Paul, on that side of the equation, the net credit side, which is small, which helps with the low risk of this potential strategy. You're focused in the other direction, where you have the infinite profit to the downside. So let's just take a look at the structure. And I'm going to go 1 week out would be the 23rd, of course, 2 weeks out would be the 30th. All right, so let's go to the 30th, 14 days away from today. We'll start there. I might go further out in time, and I'll explain why in a moment. But let's just take a look at the put options that are available. SPY, I'm sorry, of course, right now, closed today at 288.81. Let's call it 289, roughly. So 289 is at the money. And this price here is just about $4. Okay, so let's go ahead and add the at the money short put, slightly in the money by 9 cents, but again, this depends on the direction of the position. Now, I'm probably going to have to go to the 281 or the 282 to get a credit. Really, it looks like the 282. Yeah. So we're going to buy 2 of the 282s for about $1.93, and we're going to sell a 289 for probably about $3.92. Okay. This would be the structure of the ratio put spread. Sell 1, buy 2. Now it's naturally going to grab the midpoint prices for me, but yeah, this is going to be 193 and let's say 392 here as well. Give us a little bit better pricing. All right. Sorry about that. Now, this isn't a great example. Why isn't this a great example? Because what we're missing here, and should probably increase this, but what we're missing here is there is a break even at 288.94, but there's also a very low break even here. This would continue to go this direction. So the profit is really a bearish position. What Paul might be using this for is a hedge on the strategy. I'm sorry, hedge possibly on the portfolio. Why? Because what we saw earlier this week. If the market falls, then we get this sort of profit in this direction to hedge other positions we might have in our portfolio, straddles, strangles, which would be profitable if they were longs, but if they were short, or if we were in bull put credit spreads or diagonal calendar spreads with a bullish sentiment, the gain on this hedge, one of the many hedges we could use across the market, would help minimize those losses on those other strategies. Okay. Why is this structure so wide? Well, it's because I had to go 7 points apart on this spread in order to get that small credit of 5 or 6 cents. Why is that important? Well, what Paul wants to see is that if he's wrong and the stock moves up, he doesn't necessarily want to see a loss. What would happen if the stock moved up in this case? All 3 puts would expire worthless, and he'd keep the small net credit. But we saw how hard it was with SPY particularly, and it could be because volatility is still relatively high, to get a structure where we could get 30, 40, or 50 cent net credit here in the shorter time frame. And I see a perfect comment on that. And I'm sorry, so that's what he's looking for, is more credit up here in case he's wrong. He still gets the credit, but if there is that massive decay down here, he gets the profit. And I believe this is my friend that I was referring to earlier here. It's Mark. Mark commented here. This is a comment we like to use. Mark's comment here, Paul, is that he likes to go 60 to 90 days out, and even in the 75-day range for the ratio backspreads to avoid this death valley, the valley of loss. Okay, so by exiting before even, there's less than 30 days to expiration to try to get out of this value. And that's Mark and I talked about this before and about the management techniques of this position when it starts to move against you. Now, I could structure this with an in-the-money put, and I could get a higher net credit. I could have gone to, let's say, the 290 or the 295 put and maybe bought 2 285s, a 10-point spread, and we might see something that looked like this with a higher net credit and then the profit this direction. Why did I start with the at-the-money put and not the in-the-money? Well, remember, even if I'm in a bull put spread, which technically you are, this ratio spread is technically a bull put spread where you sold one put and bought another. And then you bought an extra one to give you this directional. But if you sell a bull put spread where the short put is in the money, remember you can be assigned on this short put at any time. Doesn't have to be related to news, doesn't have to be related to anything. Your goal was not to necessarily own stock on this position. So if I sell the in the money and I buy the puts below the stock price, well, the benefit of this put, allowing me to exercise it to deliver if I'm forced to buy shares of stock at the short put strike price, doesn't kick in until the stock goes below that mark. If it's between, I can be assigned. So I'm starting it at the money, even though you're expecting a downturn or trying to hedge with a downturn so that stock could stay the same or move up. And yeah, I'm slightly in the money, and that's actually a little bit risky. I'd probably go with the 288, but then we'd have to go to the 280 put, 281 to be able to do this at a credit. Okay, so this is the structure that you're looking for, and it is a good hedge, but you have to build it in the sense that you want. Let's get off of this 14-day out trade. Let's take Mark's advice, because he trades these more actively than I do. Remember, I'm a good educator, I think, personally, but I'm not an expert. Some of these strategies I don't trade in my personal account. Not to say the put back spread is a bad strategy for market hedge at all. I personally just tend to buy VIX calls as a market hedge. Sam, who's also with us for a lot of these Friday sessions, he tends to buy shares of UVXY and maybe trade them as a covered call or as a collar, depending on what the market's doing. But let's go see if we can get a range in that good midterm range Mark mentioned. Let's go 70, 75 days out in time. Okay, 63 is best in October. Don't want to go 91 on the outer edge. Let's go to 63, pretty good range. Again, I'm going to focus on our 290 area, 280, 289. Okay, so there we go. Here we go, 288. Wow, I got to go much further. It's a lot of volatility. So this is only $8 to buy two. I'm going down to the 273 strike. That's kind of rough, isn't it? But that's okay. Let's just go here. Big spread. So I'd still have to put up the 14 points here in that bull put spread section, wouldn't I? Yep. Okay, so the monetary, see, here you start to see the peak back up, and eventually it'll, oh, but see, this is done at a debit. That's okay, it's 27 cents. This is part of the problem here. We have this about, yeah, the farther out in time, the wider the back spread tends to be. That's exactly right. So that's another thing to factor in your discussion, Paul. I'm sorry, your thought process is if you go shorter term, the 14-day period, you might not be, you don't need to go as wide as the spreads. When you go further out in time, you're going to need a wider spread difference, which means what? This lower break even is also much lower as well. Okay, but Mark's playing this as more of a time spread, that he's planning on closing early, not necessarily staying into it. And if you do get the dip that you want, you could do it that way. It's a complicated strategy. There's a lot of ins and outs on it. But essentially what we're doing is a bull put spread where we added an extra put, hoping to get a credit here, which we saw is difficult without a very wide spread. So if we're wrong, we receive a small credit, and if it continues down, we get the market fall, then we get the profit in that situation. So how would you manage it? Let's go back into this. How would we manage the position? Well, now that we know the structure, I'm sorry, folks, let me do this. Okay, so how would we manage this position? Well, if the stock is moving up and you do have a credit, well, you're probably just going to let it go. What's the sense of trying to manage it? Sure, you could buy to close this put for a cheaper price and try to roll it up to higher strikes to try to get a little bit more premium, but now you don't have as good a probability. If the stock pulls back after you've moved it up, now you could be in the loss area. So it's maybe better just do that. Mark already recommended his management of closing it before 30 days to expiration, even if you go this far out in time. When you start to get into Death Valley, you may want to consider rolling this put down, because remember, you could be assigned at any time. So if it drops below your short put, it starts going into Death Valley. You may want to consider buying to close this short put and rolling it down so you don't risk early assignment. Now this will probably be done at a debit, so what's that going to do? That's going to move this lower break even down, and it's going to adjust whatever credit you had, maybe down to the debit. Okay. If your sentiment is changed, what you may be able to do is sell two of these central puts here, the bought puts, as the stock's falling. Because yes, this is gaining in value as the stock's falling, but so are these slightly. And your sentiment has changed. You're still slightly bearish, but maybe not as much as you were. You might be able to sell these two and move them up, what we call the pendulum adjustment, where you turn sort of the ratio backspread into a bear put debit. I would sell these two and only buy one at a higher strike. So now I'm in a bear put debit, which hopefully is still at a profit line if the stock stays below the short put strike price. But now I have a higher strike long put, which I can use at any time. If this is assigned early, I can exercise this immediately, get out with my profit. Sell the two, buy the one. If your sentiment is changed to slightly bearish instead of a big bear that you're looking for to hit this range. Okay, so that's my thoughts and comments on this strategy. Does it have to be done at a credit? No, it can be done at a slight debit, but what does that depend on? It depends on, one, what are you comfortable with? So what is your comfort zone for this structure? Number two, big one, expectation. Okay, to get the structure we wanted even 14 days out, we were at a strike difference about 9 points apart for a small credit of only 6 cents, which would have been destroyed by commissions. So in this example, I'm not saying this is the best security to do this. We're looking at it because it's likely being considered as a broad market hedge for the whole portfolio, because if it falls, we get that profit. Okay, but what is your expectation for a fall, and does it make sense? See, even in this structure, in the next 20 to 25 days, what if this fell 10%? Meaning, what if this fell to 260? SPY fell to 260 in the next 30 days, right around September 18th. Well, we're at a profit of $253, okay? So what I have to, with the curved line, not near expiration, our maximum risk is $1,427. This is the worst case scenario right here at the peak. Okay, but if it falls that 10%, 28 points to 260, you're looking at about a 22% return. Favorable, very favorable as a market hedge. But if it only falls 5% and drops $14 down to 274, you're at a loss, theoretically, of $229, or 25% of the maximum risk that you put up for the margin requirement of the two strikes. Okay, so that is why we're taking a look at this structure here. Is it best to do it a credit? Yes, Paul, it is. Don't get me wrong, but it's okay to do it a debit depending on your comfort level. Is a strategy good? Yes, but it depends on your expectation of a decline for the underlying security, and you want to map out what it would look like, and would it meet your goals of 5% decline, 10% decline, 20 days from now, 30 days from now, prior to the expiration, as Mark mentioned. How would you manage the position? Well, based on the structure. If the stock is falling as you want, but you're entering Death Valley, you can move down the short put, but again, that'd be done at a debit. And you also have to consider that these are gaining at the same time, but maybe it's best to let it go because that's what you wanted to have happen. If in this case it moves up, you could adjust the spread up. I don't know if you necessarily want to do that. You could just adjust the short put up, but remember, now if there's a retraction and the stock pulls back, that new short put strike, you look for a little bit extra premium, might now be in the money, and you may have to manage it for higher cost. I don't want to get into any elaborate things of creating a double backspread to manage this position, adding a call backspread to manage the put backspread. Now 6 working option legs instead of 3. Ugh, it's not my style. It might be useful, or converting this into a iron butterfly or a long butterfly or a long condor. It gets too complicated at that point. Okay, so just know the chart, know the graph, which you do, Paul. But make sure that the reason to get in, does it have to be done at a credit? Well, matches your comfort level, that the graph matches your expectations of what could happen. And if the stock moves up 5 or 10%, does the loss there also match your expectations? And 3, what is the real goals of this position? Is it just a strategy that you're using to get a quick profit? I might consider a credit spread or debit spread a little bit more in this scenario for a quick profit as opposed to this. Is it done as a market hedge? Okay, well, that's good. That's what we looked at here, but make sure that if you're using it as a broad market hedge in your portfolio on SPY, as you mentioned, which is what I think if someone says, hey, I'm thinking about this strategy one way or the other on SPY, I consider it's usually a market hedge of some kind, a portfolio hedge of some kind in case something bad happens. Then make sure that if you do see the drops you're expecting, that it does give you the profit that would hedge the portfolio correctly. So comfort level, expectations, and the goals for why you're using this in your portfolio, match those up. If you don't get the structure you want, the spreads are too wide, then you have to analyze that. This expectation here, I should have mentioned. Paul, this expectation part also falls into the question you asked that I don't have a great answer for. Mark's experience, because he's traded them more, gave us good insight. 60 to 75 days out in time, perhaps look to close it before you get 30 days in. But suggestions on the expiration are, what is your expectation? Do you think SPY is going to fall that 10%, that 28 points in 10 to 15 days? Or it could happen in 20 to 30 days. Are you expecting a 5% drop maybe in the next 10 days from some event coming up, but you potentially could see it falling 15% or maybe 12% in the next 30 days? Well, if that's your expectation, set the expiration to 30, 45, or 60, beyond the range of where you expect the event to happen, because it doesn't do me any good to force a weekly, maybe lower cost, maybe slightly higher net credit with closer strike prices for next week's expiration if that never comes to fruition. If my expectation is I expect this to be down 10% in the next 25 to 30 days, why am I trading something 7 days out? I want to place my expirations where my expectations are. That's a tongue twister. I shouldn't really say that too often. Or watch, now I'm going to say it during every webinar. Okay. So Paul, that's my consideration on your thoughts relating the ratio put backspread. You know, depending on the stock too, I'm just going to try something quick here that I know has only usually 5-point strike differences in non-weekly options. I'm going to go 35 days out to September for Trex. Ooh, back up to 85. Good job. So I might sell the 85 at 320, 350, midpoint, get a good price, and buy 280s for small net credit. And clear out our SPYs, shall we? So I'm going to sell one here, buy two here. So this is done at a slight debit, but this is the profit. And I used a lower price stock that had 5 points, so it can give us this better sort of view. Like to see it at a credit. Maybe I get better midpoint. But in any case, again, looking at the trade, what expiration works? Well, do I expect the stock to be trading 11 points down in the next 35 days? That's the only way this trade makes sense. Otherwise, I have to go 60 days out. I have to go to October, 63 days out. Not done at a credit. And what I really want to avoid is Death Valley. So once I start getting here, it's not only because this is a wide range of probability levels where it could end up trading, because I started right at the money. But remember, as soon as it starts dipping into this level, I can be assigned on this short put at any time. These might not have triggered yet. It could be in between. So now I've got to deal with buying the stock. That wasn't my end goal. And if that is your end goal, it's a pretty interesting approach. But I just wanted to show this graph because on a lower price stock with the 5-point differences, you can get these prices a little bit different. And we can see the full structure of what this is like. So again, that's why the expiration needs to match the expectation. Okay. Mark says for rapid drop expectation, you would choose a debit butterfly. I can see that. I'm currently looking at perhaps doing bear call spreads on the VIX because I cashed out most of my long calls that were in the VIX. I've only got a few left on those as well right now with the market drop recently. Okay, so, all right, got a lot of questions coming in there. But Mark, Paul, those are my thoughts. And Mark, thank you very much. For your comments. Mark does add that it was, Mark was the one, of course, that commented. He says it was 2 or 3 weeks ago. And we talked about the one strategy to move the short options toward the underlying for more credit. Yeah, that's what we were looking for. Okay, so we've got that there. That was a few weeks ago. I just didn't see it when I looked at the archive webinars. Paul, I'll try to point you towards that when I look at a little bit later. All right, so let's see here. I got a question from KBB. I've got a question from Theresa. Might be Jerry, actually. And a question from Fernando. Darell, or is it Darnell? I always do that wrong. Darell. Okay. So everyone is coming up next here with our questions. And let's start off with KBB. All right. KBB says, what is better? Low delta, more contracts, or less contracts, high delta? For example, one contract NVDA September 170 call, or 4 contracts at 185. Thanks. This is not a real easy question to answer, The actual answer, KBB, is what we just sort of discussed. What are your expectations for the position? So what are we talking about here? Talking about buying. I'm assuming this is buying. Okay. And sorry. Okay, so if we're talking about buying, my initial thought is it has to be the 170. Okay, why? Well, because the stock's at 159. You're going to September, which is 35 days away. But that also puts us at the end of the time decay curve, where this is about 90, this is about 60, this is about 30, and this is about 10 days remaining where you see the rapid time decay. Okay, so we're right about here. The out-of-the-money options tend to decay very quickly unless there's a movement in the stock. Okay? And the true answer to your question, KBB, is not necessarily a one-off answer. It's more along the lines of what we just talked about. Where do you think the stock will go? What is likely for the stock in the next 35 days? So, NVIDIA, September, we can buy a 170 call for 291. Higher delta, less out of the money, one contract at 291. Okay, there we go. Okay, so we know that the risk, midpoint, I'm sorry, is 295. So we've got $295 in one contract here. Upper break even at expiration we know is 172.95. Now, again, we're buying 35 days out. Let's say in 10 days from now, 14 days, 2 weeks, let's give it 2 weeks, 8/30, that next expiration, the stock goes up to 165. Oh, not 465. Stock goes up to 165. We'd have a profit of $40. Okay, we've got some time decay there. The call goes up to 335. We expect it to go up to 170, right at the money, in the next 14 days. 11-point move, excuse me. So you're at a profit of 265. Option would go up to 560. Okay, and that's just at the money. Now, same thing, but let's reverse it. Let's take your other option, the September 20th, 185 for 58 cents, 62 cents roughly with midpoint. We're going to buy 4. Okay, so we've got a price of 240. I could probably buy 7. I'm sorry, I could probably buy 5 and be right about that 300. My apologies. Okay, but let's just take your 4 example. 4 contracts here with a lower delta, further out of the money, much higher break even. But we've got 4 contracts. So what happens in this scenario? 8/30, 14 days out. If I put in the correct stock price of 165, what would we expect? Well, here we go. We'd see a loss of 50. Now remember, you're a gain at 40 cents on the 170. That's all theoretical, but you'd be a gain of 40 cents with the one contract of the 170, whereas further out of the money here, it hasn't kicked in. What did kick in? The time value on your 4 contracts. The time value decay on your 4 contracts because you're halfway through to the expiration period. Climbs to 170, where we are at a profit of 265, and that's a full profit. The option was worth about 560 theoretically. Here you only profit at 182. Okay, so theoretically, we can see that buying the lower strike one in one contract, closer to the stock price in a sense, is going to give you better bang for the buck because you need much more movement in the security. Now, of course, hindsight being 20/20, I could always say, well, look, if the stock shoots up beyond my expectations, it goes to 190. Let's go 195. Let's go 10 points above this call strike. You're going to have a profit of $4,000 here on your 4 contracts at 185. With the 170 at 195, it's going to be deeper in the money. It's going to be at about maybe $26, $27 value. intrinsic, 25 points plus a little bit of time value, maybe $1 or $2. So as you go higher and higher, you might not see the profit. Let's verify that, okay? Because the volatility might be playing me for a little bit of a sucker here, but let's take a look. So the September, I apologize, 170 call again, 295, buying one contract. And let's say NVIDIA goes to the moon, reverses its current numbers from 159 to 195 in 14 days, a little bit less than halfway to our full expiration of 35 days. You're at 2,250. So you kind of see where I'm going with this. If you see the nominal move, we looked at 165, 170, maybe even 175. The 170 is going to be paying out more. We actually might be at a loss or just a small gain on the 185. Now, if it really rockets up, you've got the 4 contracts that you paid less for. So if we are up at 200, 190, we're seeing almost double the return. Again, base it on what is your expectation and what is likely for this stock moving forward. All that being said, I got something better for you to use. Okay, on Power Options, underneath the Long Call tab or the Long Put tab, you can also access it here in our Signature Tools tab. There's a tool called the Long Option Finder. And this is a very simple tool because all I have to do is put in my stock symbol, my expected price for the stock. Let's say it was, no, let's take halfway there. Let's go 190. Still pretty good. And either way, you were dumping about $200, $300 into this position. Okay, so I'm going to put in $300. Is that right? Yeah, about $300. And the expected date, oh, I'm sorry, let's go to 8:30. Okay. In that instant, what this tool did is it went out and looked at every available option for NVIDIA. And it grabbed its current price, looked at its volatility, and it calculated what each option would be worth if the stock hit your target price on your target date. And we see here that the September 185 call, we could afford to buy 12 contracts, 6 September 185 at 23 cents. We could afford to buy 12 contracts. Why not 4? Well, remember, we were looking at the standard September, which is another 14 days away from here. So the price was a little bit higher, wasn't it? It was about 40 cents. Okay, but these are all vastly profitable. But why is it arranged like this? It did show the September standard expirations KBB. It did show October's. It did have August's in there. I should have put August 29th. Let me put August 29th because it is a computer and it's reading the 30 as the 30, so the 30s wouldn't be profitable. So let's go to the 29th. And I'm sure it'll pull up the 30th of August. There you go. So if that's my expectation, then the video would be around 190 on or around the end of August. 30th of October 180 call would give me the best bang for the buck. Now it's based on theoretical pricing, but is it? This isn't so much based on theoretical pricing because it took the closest expiration. Why? Because it has the lowest cost. And the fact of the 180 calls being worth $10, the August 30th 180 calls being $10 if our stock's at 190, well, that's about as intrinsic as you can get because it's on expiration day or the day before. So this 4,446% return is accurate in that scenario. There's no guarantee the stock's going to hit 190. This is based on your expectation. Your buying calls is my assumption, so you do have an expectation of a time frame and when NVIDIA is going to hit that mark. And so this tool here, the Long Option Finder, again, under Long Call or Long Put, or under the Signature Tools, put in your stock, your expectation, your investment amount. I used the 300 because that was about the cost of your 165. I'm sorry, your 170 call or your 185s. I could have put 250 in as well. It would just change the contract number, but the percentage return would be the same. Okay, so this will help you better identify based on your expectations and your target price which is the best option to go with, whether you're doing 1 contract, 6 contracts, 4 contracts, 13, whether you're using $300 or $250, this will better answer your question. Now, again, and we would see this, if I only expected it to go up to 170, what am I going to expect to see? I'm going to expect to see the lower strike calls because the 180s wouldn't be profitable. right? They're losing time decay, and they're not close enough to at the money yet to yield a profit. But now I'm just in the one contract range. But we see here in this case, if I only thought it was going to go up to 170, the 30th of August 165 call gives me the best bang for the buck. Above the September 170, oh, it didn't show the September 165. I apologize. I was looking for that one. But the the near term September 13th 170 and the 6th September 170 would give us a better return than that standard expiration 170 call. This is a very powerful tool for you if you're going with this approach for buying calls and trying to analyze, is it better to do one or the other? You can see it right here. Put in your investment amount because you already decided you're putting in X amount because you've got one contract or four contracts based on the price. And this will show you exactly which call, in theory, based on Black-Scholes pricing models, and also, just intrinsic alone. 170 here on 829. Yeah, this 30th of August call is going to be worth $5, maybe an extra cent or two for some time premium, but that's it. But that's about right. It's going to be worth $5. Okay, so you'll see right here which is the best call to buy. All right, moving on now. Is this to Theresa/Jerry? All right, Theresa. Mike, if you have a married put that has gone negative, I was thinking I was going to see an email from Jerry this week regarding ON, okay, and you feel it is not going to turn around anytime soon, okay? Oh, sorry. All right, so we have a married put position. Let me just go here while I read the question. So I bought a stock. I bought a put option to secure it. Maybe I buy a stock such as ON Semiconductors a few months ago at 22. I buy the 25 strike put with a 7% risk, and my put's out to January of 2020. And ON dropped down to 19, started to come back to 21 to 22, had a poor earnings, fell down to 1680, and then jumped back up is around 1780. So that's the kind of scenario we're talking about. But the question here, is it better when you don't think it's going to turn around anytime soon, you decide to close the position? How do you decide to exit? Would it be better just to exercise the put or sell the stock and sell the put separately? A little bit of different question where I thought you were going, but if you decided that it's not worth it anymore, it sounds silly. I was from last week's webinar. Sorry, it sounds silly. Theresa, if you've been following the semiconductor, the ON semiconductor, which is not in this portfolio, it's not in our webinar portfolio, I apologize for that. But if you're following that one, no, that's it. Okay, in any case, I haven't closed it yet because I know a lot of the hits that were taken were from this tariff discussion. If the tariff discussions get resolved and the tariffs aren't as high, Dell is getting destroyed. That's another one I'm in too. But if the new tariffs on China are implemented or they reach a settlement that's favorable for both sides, hopefully, yes, I hope the United States a little bit more, but however, this is going down and hurting all of us. If that's settled prior to when the new tariffs might go into place, I think those stocks are going to move swiftly up. So I'm waiting, not waiting too much longer because I'm getting closer to expiration. But that's why I bought the January put to begin with, to have a lot of time in case something outside the performance of the stock affected it, which is where we're at. But you don't feel it's going to turn around now, so you want to close it. The main question is, how much time is left on your put option? Okay, let me do this. I'm going to pause the screen, ladies and gentlemen. So you're going to hear some clicking, but you're not going to see anything. All right. Now, let me unpause. And what you're actually looking at now is the proper portfolio. You see Dell here, I mentioned it's down 25% from when I got into it. I'm at a loss of 2% on my actual trade. DR Horton, that's one I was going to open yesterday. Anyway, so here's the on position. It's down 23%. I'm at a loss at about 7%. That was the max loss of the married put. I bought it at 22.77. It's at 17.54. Okay, now I'm holding the 25 strike put. So when we look at this position on the profit and loss chart, actually I'm going to go to position actions and then position analysis. This is where the tool here from the portfolio, I can evaluate the true max risk on the position. Where I stand right now, actually it's much better because it's pulled back. I'm only at a 6% loss with a 7.3% max. Yeah, that sounds chintzy, but it's still good. But look at it this way. The one thing you have to consider is how much time is left on the put. So I've got a 25 put here. So my 25 put is $7.46 in the money, right? Mathematically, 746 of intrinsic value. The current price on my put, 720. But the ask price is a little bit higher than that. So the midpoint, what you see what I'm looking at here is if my midpoint, if the market maker is forcing me or forcing the midpoint to be right at intrinsic value, I may be tempted to exercise it because there's no value in trying to pay 2 commissions to sell to close it. I'm just going to exercise my put option, get out of the stock. In most cases, what you'll see is if I still have 4 or 5 months to go, even though this is $7.46 in the money, it's really deep in the money. Its delta is almost at 1. It's at 0.98, I think, last time I checked. But what you'd expect is you'd still probably have 50, 60 cents, maybe $1 worth of time premium. This put should be priced probably around 8.20, 8.10, somewhere in that range. So what does that tell me? That's about 60 to 70 cents of time value remaining in that put. If I exercise the put, I deny myself that 70 cents. So I'm better to sell to close the put, sell to close the stock. Get out of both, get the time value. However, if it's really closer to intrinsic or just 10 cents, 15 cents more, depending on what your commissions are, you may reach that decision where it's better to exercise the put, have your broker exercise the put, and just get out hopefully with 1 commission, okay? But if you've got time value, that's the reason when you buy the far out put that you can use it for different management techniques and more. If you've got that time value, then go ahead and sell to close the put, because exercising it, you're denying yourself that time value, and you'll get out for a worse profit than if you, or worse loss, a bigger loss than if you sold to close the put and sold to close the stock. Okay, that's part of that time value discussion in the married puts that we talk about in the blueprint there. Yes, I did log on to my personal account, so that's why we're looking at the on position. But in the blueprint there, that's talked about in the first couple of chapters, plus, of course, the 9 different income methods to use to adjust the position if it does go against you. And I evaluated some adjustments. If you've been following the ON semiconductor position, it took a big hit from earnings last week. And it wasn't that I was ignoring the position because I was on vacation. I knew it was coming up, but the prices even 2 weeks ago and 3 weeks ago to buy an extra put to sort of create that synthetic strangle were too expensive. So the one play I did look at where I could have done this, even with the stock decline, the day that it hit 1680, this was still at a loss of 1.5%. With that extra cost, that would have increased the loss in this area to about 12.8% beyond 7. So if it's trading right in between. Well, now the stock's come back up. So the loss, if I had done that income method and created this synthetic strangle in anticipation of earnings, would still be at a loss of 4%. As you saw, I'm at a loss of 5.9. Hey, 4% is better than 5.9, but it took an extra cost to do it. I wasn't sure if it was the right play because the premium is too high, so I didn't do it. Might have worked out better than where I'm at right now, but I still might manage the position, again, based on expectations. And if the expectations that this sort of trade discussion and pressure on the semiconductors and tariffs on semiconductors and chips and technology will go away, then I might see a pop on these as well. Okay. All right. Now, Fernando's question might be related to this. Fernando says, is it a good idea to mount the backspread on the maximum loss point? In this case, the stock movement can only be an advantage. Not really. It's not a stock repair. The ratio backspread, that put ratio backspread, is done in anticipation of a movement, not after the negative movement has happened, because you don't get much benefit of it to really hedge the loss you've taken on the stock. ON is a good example. Let's go to the custom spread tool. I think ON is maybe bottomed out at the $17 range. Okay. I was surprised to see it go to 1680, but that was on the day that the poor earnings came out. It sort of came back up after. Oh, I'm sorry, it hit 1680 on Wednesday when we saw the huge market tumble again. It went back to that level, but it's since come back up. Okay, so let's say I'm in ON at 20, and we're in the $17. Oh, not 20 contracts, 100 shares, 20. Or even if I'm just anticipating the stock coming back, and I go out to September because I have to, and I sell, where am I at now? It's 17. Ugh. Well, it's possible, but I don't like it. All right. I can't do that. I really shouldn't do this example. I don't like it, but I'm going to. 18.16. Really big premium here. Sell 1, which remember is not covered by the stock, buy 2. Okay. So this ratio put spread would give me a good net credit of 70-80 cents. But because I own the stock, it just increases the risk, right? Because I can lose on that ratio spread side, but it doesn't have the continuation here, right? You don't get this on the stock, Fernando, if you own the stock and it's dropped. Why? Because one of these puts is covering the short put, one of these puts is covering the stock, so it does here. It doesn't go here, okay, like the others do. And it's not a repair to do. Now, let's say if you're talking about, I think it's bottomed, I think on is bottomed, and I don't own the stock, I'm going to try to play this as a recovery position. Well, no. I can still take 100% loss, only $150 in this case, but look at the range of Death Valley, $14.50 to $17.50. If it goes up, hey, great, I make 50 cents. Okay, but if I think this is bottom and it's going to recover, there's probably better plays to do than a ratio put spread. If I'm wrong and it falls, well, I don't expect it to go below 16. Anything can happen, which is why I have a married put in place on this position in the first place. And I have the VIX calls in there and my portfolio. Anything can happen, but look at the structure. Look at the width. You think it's bottomed and you have this. What other extra protection are you getting out of this? You know, you still have a margin requirement here of 150, the 2-point difference in strike prices minus the 50-cent net credit. Maybe you did the 18.17 and you have a tighter window here of upper and lower break even. But I need the stock to drop to 14.50 for this to kick in. That's not my expectation. If another drop occurs, I don't think this stock would drop below 16. You know, another 600 to 800 point drop, I don't think this would go below 16. Guessing, but I don't think that would happen. So that's what this was more related to earnings, and then with the rest of the market pullback as well. So I don't think, no, Fernando, this is a structure that I'd use if I own stock as a repair. I would just use the standard stock repair that we have on PowerOptions. You can just put in your, similar to what we saw with the long call, long option finder. I just put in my stock symbol here, and I'd click in the upper right here to stock repair. Oops, sorry, folks, stock repair. And it would show me potential repair positions using a ratio call spread, not a put back spread. Okay. Darell, I am going to get to your question. I'm going to skip it, though, because I'm going to answer these 2 quick questions first, because yours is complex. In a sense, it has multiple levels to it. It's a great question, but it has multiple levels to it, and it all depends on the strategy, Darell, that you're trading. So real quick, KBB, going back to the question we were talking about earlier, he asks, does PowerOptions give good charting platform to decide trend and next level? We offer links whenever you're researching a stock. When you pull up a stock on the search, for example, whether you're looking at the quotes page, the stock detail page, anytime you see a stock appear on any page you're on, use the Edit More Information button here, go to Charts, and you can go to Big Charts or Stock Charts, okay? I use Big Charts. We added Stock Charts per request from a customer. This is not my structure. This is not a recommendation. I didn't even see what I clicked. Starwood Property Trust, not familiar with them. But what I typically do, this Big Charts is flexible. So first thing I do is usually go to 6 months or so. I think Ernie prefers 3-month chart. And I'm going to put in an SMA 20, but you can use EMA. You can use an EMA 2 line. So if I put an EMA 2 line and put in 10, it'd give me the 10 and the 20. But I'm just going to look at the SMA. And one of the reasons why is because I like to use Bollinger Bands for some of my long call positions and others. I also like to look for the MACD depending on the strategy. I'm doing a bull put credit spread. I'm doing a married put, standard collar. And I also look at MACD if I'm doing a bear call credit spread or something else. Volume. But you see, those are just my selections. You have things in here for stochastic, Williams percent R, money flow, percent short interest, not something I typically use, rolling earnings per share, and so forth. I might go to the large chart as well. All right. There we go. So this allows you to customize it. The MACD is not as positive as I'd like to see it here. It has broken up above the 20-day moving average, but that's market conditions, isn't it? Meaning that we had that big decline and then everything started to rally back the past 2 days. So it did have a Bollinger Band breakout on the upper side finally. It's been trying to ride and show a breakout, but it closed 2 days above the upper Bollinger Band. So that's an interesting looking one. But I'm not fond of the MACD right now either. I want to see this structure here where the blue line just crosses the red line. Here would be the entry point. Actually, I'd look for, you know, kind of in this range here when it was at 2250. Now we're at 2375, 2350. Okay. So that's something that you can use. Does it help you decide trend to next level? Well, we have webinars and how I use big charts here for my personal use and what I look for, and you see what kind of criteria I'm using. The stock charts is also extraordinarily flexible. You can structure that the way that you want as well. So I can just use the one link here, and I can go to stock charts. And we can custom a different sort of chart view, but you've got a lot of customization that you can do here as well, including color scheme. I just mentioned that because it's not on the other one. But yeah, you can do different parameters, overlays, moving averages, indicators here as well. Looks like I've already saved this because I've got the RSI and the MACD. I can add some of these other ones, shaken money flows in there. CCI I don't use. Percent Bollinger Band I do use, but I use that in the search. Trend meter, Change trend meter. It's not what I'm familiar with. Yeah, but there's a lot of stuff in here. ADX lines, I've heard that mentioned once or twice in these webinars. So you can customize both of those. But we don't draw the charts for you or say, yes, this stock is moving up, this stock is moving down. Okay, that's not what we do. We don't give direct stock recommendations, but you can set up the search to look specifically for what you want to see. Things like if you wanted a positive earnings per share growth, you wanted a certain PEG ratio, for example, or if I wanted stocks that were above that upper Bollinger Band, were above the 20-day moving average, had crossed over the MACD by at least 1 or 2 days to see that positive cross, or if I wanted a certain RSI level or historical volatility, we could put that in, make those edits, and now in addition to looking at the chart, there's Starwood Property Trust, just had that crossover recently. Hasn't crossed negative yet, but is still holding up above that with the positive MACD. Okay. Now, if I remember correctly, Darell and I have had conversations in the past about credit spreads, some debit spreads, and other strategies, but mostly in my mind, I'm thinking credit spreads. Darell's question is one of those ones. We had a webinar a few weeks ago that I called the $1 million question, and it was along the lines of how can I be profitable long-term with options trading? That's archived on YouTube and on PowerOptions. A little bit stated a little bit differently, but that was the end-all question. That was the end result of the question where it needed to go. But Darell's question is similar to that, but a step beyond. And Darell's question is, can you explain when and why it is advisable to roll down, roll up, and out, and why? Okay. It's advisable to roll down, out, up, sideways, whatever, when you have a loss on the position, but the reason you have a loss on the position is because of some outlying factor not related to the performance of the stock, i.e. what happened this week, which is why Darell's question is very timely, meaning that the market pulled back because of several factors. Fear of the inverted curve again, talk of more tariffs, other things putting pressure on the direction of the market. While we're talking about this, let's go back to our charts. And during a coaching session this week with Jerome, a different Jerome, he was asking me related to, well, what do you think the market's going to do next? And I said, I can't really answer that question because we're in a headline news market. I can't expect what new headline is going to come out this weekend, Monday morning before the open, Monday during the day, Tuesday during the day, after Tuesday close. We don't know. It's been stressful, which is why I've been focusing on the married puts a lot in my personal portfolio, as I always do, but also collars and VIX calls to hedge my bull put credit spreads. But when things aren't being stated, sabers aren't being rattled. Now, the Inverted curves are a different story. Okay, that's something that's, yeah, we're focusing on that. That is there, and that's something. But before that, the best way I could answer his question was, what has the market done before these things happened? And you can go back and look at the dates when these events happened. But the market's been wanting to do this. It's been wanting to do this. And we go back a year, it's been wanting to do this. It's been wanting to do this. But it's not, because something happens. Something that peaks volatility. Something that causes global recession fears. Something that does that. A statement, comment, you all know where I'm going with this. A rocket is shot off into the Pacific. And I just don't know. But the market seems to want to go in this direction until these outside forces are happening. Apple's still a good stock. Netflix is probably still a good stock, though they had some subscription worries and concerns on their last earnings report, if I'm not mistaken. But aside from that, the market is still wanting to do this. It's these outside forces and fears, and they're justified. The fears are justified. The outside things that are happening, I kind of just raise my eyebrows at. Really, we're doing this today again? But we are, and here we are. So now, let's get back to Darell's. I'm sorry, getting sidetracked. Let's get back to Darell's question. I'm in bull put credit spreads. I'm in 3 of them that actually all expired today. When this happened, all 3 of them were still out of the money, but one of them was at a loss of about 4% if I liquidated. It was still about 4 points out of the money. That was on CMG, Chipotle, I believe, right? Yeah, CMG. And the other one was a loss of about 5% if I liquidated, and the other one was still at a profit of 1.4%. Now, this is strange. I opened these positions in around the 1st of August for today's expiration. They all 3 did expire worthless, even with this hit here, following the weekly bull put credit spread search on PowerOptions that I use. In any case, I didn't roll at this point because my triggers weren't hit. If my triggers were hit, would I have rolled the positions? Well, it depends on where these were. Okay? What do I mean by that, Darell? I'm in a bull put spread. Something comes out in the market and the stocks fall, but my stock is still strong. Its last earnings were strong. There's nothing about my particular stock, and the stock sector or industry is not really going to be affected by these new tariffs or what's going on. But the falling tide lowers all boats, just as the rising tide raises all boats. Okay, so the stock moves down to my bull put credit spread point, and I see that I'm at maybe a 40% loss with 5 days to go to expiration, or a 20% loss. Now in this range, I'm contemplating rolling down and out for protection. What do I mean by that? Well, let's say I had sold the 100 strike put, and I've got a 97.5 put. And my stock fell suddenly from 108, 109 to 101 on Wednesday. And now I could liquidate this for 40% loss. Well, this wasn't related to my stock. So I may be able to move this down, close this out for Friday's expiration, and roll down to, let's say, the 95 and maybe the 92.5 or the 90 for August 30th expiration, 14 days away from my existing expiration. It would cost me a debit to do that, so as long as I'm still at a reasonable profit, I might do that for protection. Why? Because I thought this was an isolated event, and I thought that the market would pop back up, as it did, unless someone opens their mouth again, or someone fires a rocket into the Pacific, or something along those lines, or Hong Kong. We can talk about all the different scenarios, but that's sort of the idea. I know that's a poor drawing. Let's just take an example. But if it's not related to my position directly, it's not related to my stock directly, Darell, it's a market condition. Now I have to ask myself 2 things. Do I think it's going to continue down in price, or do I think it's going to recover? There's no way to know. And if you don't know, don't roll. Get out if it's in your loss range. See, with my bull put credit spreads, I've still been averaging around I'm going to give you a wide range here, but about an 83 to 87% success rate over 3 to 4 years. I'm sorry, 3 years. So some years are better than others. Some years it's peaking out at 88. Sometimes it's at 83. So I'm in that range. Now, why do I mention that? It's because with that target success rate that I'm looking for, I'm okay even taking 17% of the time I lose taking a 50% loss on the ones I lose on because I'm still going to be profitable long term. That's my structure. That's what I look for. But let's say that for today's expiration, let's just put a graph up. I'm sorry, folks. No, that's not a good one. That's a better one. Yeah. I'm sorry. I'm building a bull put credit spread that did expire today. Let me get the 290 out there. Let's say that I sold the 289 and bought the 287, and I got 65 cents here and paid 30 cents here. No, that's way too much. 40 cents here. Okay. I double dipped on that one. I had 2 points in there. I should have been just made it 20, but okay. So we're at a 14.3% return if the stock stayed above 289. Now, I know it dropped further than that, but let's say I'm coming into today's expiration and the stock is here, but it's been rebounding after that fall. I didn't want to take the loss here. I thought the market was going to recover. Now, most likely, I'll be honest with you, Darrell, during that big decline, if I was in this spread and the stock, when SPY dropped down to this level, if I could have closed or liquidated for 40 or 50% loss. What do I mean by that? Well, my max risk is 2 points. So if I could have closed this for $1 loss at a debit of $1, maybe even $1.05, or at a debit of, let's say, 85 cents, I would have closed this, taken the loss, and moved on. All right, but now we're here. And coming in today's expiration, it's moving back up. It's close to my strike price. I took in this 25 cents, but naturally with the stock at 288.85, it's going to cost me 20 cents or so to buy this put back, excuse me. So I'd still make 5 cents. But I think this is going to recover and move back up as long as no one says X or Y. So what am I going to do? I might roll this down and out. How would I go about doing that? Well, I already mentioned that I'd probably close this option for about 20 cents. Sorry for the scrolling, folks. Close this for about 20 cents intrinsic, but it would have been before market. Oh, sorry, I gotta add the other one back in there too to close at 0. I forgot to do that. Let's do that too. The 287 put has got to close at 0. 285 I'm buying to close. So let me liquidate this structure first. Buy to close 1 at 20 cents. Sell to close at 0. Might not let me put in 0, so I might have to put in 001. All right. So now I'm only at a liquidation loss of $5. I've got a straight line profit loss chart because I'm out of the position. Now I think it's going to recover, but I still want a good probability, so I'm going to go out the full 7 days, not the Monday or Wednesday. I'm not going to mess around. I chose SPY, but I'm not going to mess around with Monday and Wednesday expirations. And I probably want a good probability here, so we're going to go to the nice premiums. 282, 280. It's another 30 cents or so higher. It's 30 cents. In that case. Oh, so I have a profit right now of 5. So let me do this. Let me clear all those 4 out. Those are taken care of. Liquidated those, they're gone. Net premium of 27 cents, but I got to factor in the 5 cents. I'm going to take away the 5-cent profit from the 65-cent cost of my long put. So now here I'm actually at a better return as long as the stock stays above 282. For another 7 days of trading, I have to keep that in mind, but that's the case. If my loss when that drop happened, Darrell, whether you were in, let's say, even a covered call, but if you're in a bull put or something along those lines, and if on your spread position when the market fell, your loss is around maybe 20, 25, 30%, or you even have a small profit, and you think the market's going to recover because this was an isolated event, you might want to roll down and out. As you know, for this particular strategy, bull put credit spreads, we do have a webinar posted on the 8 ways to manage your bull put credit spreads. This roll down and out is typically what I use as number 3. What's number 1? Liquidate and get out. Sometimes you just got to do it. This loss was 60% or 70%, I'm getting out. You know why? Because to roll down and out, if I've already had a 60 or 70% loss on this spread, meaning the liquidation value is at 180 or 170, somewhere along those lines, in order to get that 180 or 170 back, I have to roll this out to probably December or January. Now we're talking months of fluctuation to be in a bull put credit spread. And at the same time, I'm probably going to have to increase this 2-point margin difference in strike prices to maybe 5 or 10 points just to get that 170 back. Because no 2-point spread is going to give me $1.70 net credit to make up for that loss. That ain't going to happen. So I might just chalk this up to the one that got away from me from an unexpected event. One of the 17% of the times I might lose. That could be 1 out of 8 trades. It could be 1 out of 10 trades, whatever it is. But 17%, 15%, 20% of the time, I might have losses on this. I want to control my average on my losses to be 40%, 45% to still be successful long term. But if I hit this loss here and it's 70%, the management to me is not worth it. I'm going to have to increase the strike prices, the margin requirement, the risk. I'm going to have to extend it almost 10 right cycles beyond what I'd normally look for using 14-day out spreads. So, but if it's only a 20 to 40% loss, okay, meaning the buyback is maybe only, I'm sorry, we took in 20 cents originally, let's say. So let's say the buyback is 40 cents. My loss is 20 cents, which was 10% of the maximum risk, or the 10% of the difference in strike prices. And I thought it was an isolated event. I might roll that down and out to look for a better probability and to have the stock recover and make back the loss. But if it's to a point where you're at 50, 60, 70% loss and you've got to roll 5 or 6 months out in time and increase your margin 10 or 6 points, it might be best just to liquidate the position. And if you're not sure, you're no longer comfortable with the market, don't do this. Don't do this. Okay, don't roll down and out. Don't increase the strike price. If you're not sure about what's going to happen next because you're taking a losses on this one, all you're going to do by rolling down and out is lower the credit in the hope that the stock moves back up and you get a 2, 3, 4%, 5% gain on a position that was, because you're going to pay a debit to do it. This was an interesting example because we had a profit, remember, when we closed the first spread, because it only dropped a little bit below our short put. It would cost us 20 cents to buy it back, and we had a $5 profit, 5-cent profit on the position. But if that was a 20-cent loss, it's almost dangerous to roll down and out if I'm only getting 30 cents because now my net credit's only 12 cents. Yes, it repairs it, but if it keeps falling because I wasn't clear on the market direction and the reason it fell wasn't an outside market event but related directly to poor performance of the underlying my sentiment has changed, don't catch the falling knife. Don't keep doing this and doing this where you're compounding your losses because you say, oh, eventually the stock has to recover. Well, it's proven you wrong 3, 4, 5 right cycles. You'd be better off converting this to a bear spread, the opposite direction. Or getting out of it, chalking it up, making sure that it stays within your average losses and more, okay? All right. Mark says, on your challenge credit spreads, by down 5%, did you mean 5% of the premium or 5% of the total risk? 5% of the total risk. I'm sorry, I didn't make that clear until just now as well, okay? All right. And so, I'm just going to, that's my thoughts on that. And Darell, most of our conversations, if I remember correctly, during coaching sessions I've had with you have been related to credit spreads, so that's why I'm focusing on that. For others that are watching, okay, if we go into free webinars and we go into the option strategies tab, and this is a public page, sorry folks, wrong button, powerop.com/webinars.asp. That is a public page. I'm going to just send it to everyone in the chat room, okay? Here we go. All right, so this is a public page. You click on option strategies. There's discussion for those of you doing covered calls, naked puts, buying calls. Well, here's our 8 ways to manage a bull put spread from September of last year. It's one I redo from time to time. But that talks about the 8 ways and why that simply rolling down and out is not a good idea, related to just what I just talked about there, okay, in that sense. That same thought would apply to my thoughts on managing diagonal calendar call spreads, okay? Here's your webinar on managing covered call position. When is a good point to roll covered calls, how to roll your covered calls, how to just say I'm out of it to stay with your trading plan. Don't get caught in the cycle of trying to overmanage a losing position if it's bringing your whole trading plan down. What do I mean by that? Related to what Mark just commented on. If my target is I know I need to be right 82, 83% of the time, and I need to, with credit spreads, I'm staying with credit spreads, I need to be right 82, 83% of the time. That's my target with the criteria I use. And I'm looking for an 85% probability. And I know I'm going to be wrong, let's say even 17 to 20% of the time because of market fluctuation. In order to be successful, I'm looking to target around an 11 or 10.9% gain with only losing on average 45% on the losers. And if I stay with that, I am hitting my goals and exceeding them for that strategy in my portion of my portfolio. Okay, so I can have a little bit more losses and still hit my target. I can get smaller returns and still hit my target. There's a little bit of wiggle room. But the moment that I take one of those spreads where I have to target around an 11% gain with an 83% success rate and an 85% probability, the numbers I'm just talking about, and I know I'm throwing a lot at you, but the minute I have to take a spread and move it out 5 months and increase the risk from 2 points or 2.5 or 5 points to 10 or 15 points, that spread is now probably making me 1 or 2% in 5 months if it works out, and I'm tying up 4 times the capital, 3 times the capital. So now I can't trade as much over here because I've taken so much of that to allocate to this one repair that's 5 months out in time. I might be better off just closing that position for the 40, 50% loss of the maximum, Mark, maximum of the maximum risk. So a $2 risk if I close it out for $1, and that includes the 25 cents I took in. So if it cost me $1.25 to close it, my loss is $1 on the position because I kept the 25 cents initially. That's a 50% loss. But if I keep that, if I just take that 50% loss, yeah, it might have wiped out previous trades, but for the next 2 or 3 week cycle, I'm opening 3 trades with a 10%, 11% gain, and then another 3, and then another 3. And if 8 out of 9 of those are correct, I most likely already paid off the $1 loss I took. Rather than holding a repair for 5 to 6 months to get 10 cents of credit and increasing the risk, because if it continues to go down, now I'm not wiping out 5 or 6 trades. If it continues to go down and I had to open that 2-point risk to a 10-point risk, now I'm wiping out 15, 20 wins, 25 wins, and that's hard to recover from. And if I keep rolling down and it keeps falling, I'm just getting it worse and worse and worse. But I've got content similar to that for those of you trading covered calls. Straddles for earnings, that's an idea of trading straddles. Managing just bare call credit spreads. Managing your long options, buy calls and buy puts. We talked about the best calls and puts to potentially look to buy for KBB earlier. Here's a webinar on what to manage if it doesn't go as you expected. Managing your cash secured naked puts. There's a variety of different management webinars here where we walk through those ideas of when it is a good idea to do it, what triggers should you use in each of those strategies to look to manage, and hey, most importantly, as we just talked about, what management should we put on and when shouldn't we potentially do a management. If the stock has completely changed sentiment on you, get out or convert it to an opposite direction. Okay, now it could snap back on you, that's true, but you don't want to overtrade, you don't want to catch the falling knife, but on the upside, I don't want to keep trying to manage a bear call credit spread on a stock that's just has strength that is moving up and moving up. On the upside, I don't want to, let's go cliche, on the upside, I don't want to stand in the way of the freight train. On the downside, I don't want to catch the falling knife. Okay, better to just get out or convert it to a different strategy to match the trend. Okay, Edison, is there a straddle-like trade add-on while still maintaining a low risk once the stock goes down after we entered a properly structured married put? Well, in the blueprint, we talk about income method number 12. That's very similar to this. Okay, so is there a straddle? You don't add on a straddle. Okay, that'll increase the risk too much. I don't buy a call and a put speculating. What I might do is if you're expecting recovery but concerned about a decline, you look into income method number 12, which is in the income method number 4 chapter of the blueprint to create sort of that potentially synthetic straddle. There's a couple ways to do it. Or one thing you could also do is do something to do that synthetic straddle with income method number 12. Don't do a straddle add-on to it. Okay, that's just going to put the risk down before, with the call and the put. Income method number 12 teaches you how to do the synthetic straddle properly to keep risk reasonable. But if you think it's going to recover, you may accompany this with an income method number 5, also in the blueprint, to sort of help you get back to break even faster. Edison, why don't you send me an email? I'm not trying to dodge your question, Edison, but I don't want to give a lot of talk away about what the income methods are in depth and how I would manage one position. We do for the basic income methods that are known, but some of these other ones that are in the blueprint, I don't directly teach on these free webinars because, well, that's why there's the blueprint. It teaches you everything and how to do it and manage it. So don't buy the call and the put. You've already got the structure of a call, but with better protection. So you could do income method number 12. You might be able to do 12 combined with a 5. There's probably a better adjustment you can use on your position. So why don't you send me that email? Just send it to support@powerop.com. Or you could send it to support@radioactivetrading.com. That way Kurt can put some of his comments in there as well related to that. But that's the best way to do it, Edison, and I'll be more than happy to look at it for you this weekend and give you some ideas and some thoughts on how I might look at a position. You don't even have to give me a direct position. I can use one of mine for an example, particularly Dell or ON. Dell's probably the best one because even though this is down 28%, I'm only at a 2% loss. And if I'm not mistaken, just check the stock research tool here. Yeah, okay. Yeah, we haven't even hit the earnings on this one yet. So yeah, it's down a lot from where I got in. I've made adjustments on this to lower my break even and lower my risk. So I'm only at a 2% potential loss on this, which is down 28% from where I bought it. That's the power of using the radioactive trading techniques. And the put still has a few months to go and earnings are coming up. So I can still play this different ways to potentially profit. And if you're a Fusion subscriber, you'll see that coming up soon. In any case, that is it. Okay, all right, ladies and gentlemen, I think that is it. I don't see any other questions that have come in. I want to thank you all for your great questions, of course, today and for your discussion. And Mark, thank you for your comments and your assistance with the ratio put spread discussion, backspread discussion, I should say, since you have more experience with those than I do in helping out Paul with your thoughts. I do want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. These discussions are based on your questions solely, not what I'm trying to force upon you as to what to do. Although you can tell I have an obvious, not just affiliation, but an obvious love and thankfulness to the radioactive trading techniques in the blueprint for the protection on the stock positions in these type of markets. But any stocks or options discussed today should not be taken as direct trading suggestions. I'm not going to open a trade on SPY. Fusion subscribers are going to see me open new married puts next week, and I like that chart on Starwood. I want to wait to see what it does next week, but also DH was in my portfolio from during a coaching session this week, and I was going to open that one as well. So we might see two or three new married puts in the Fusion subscription. But yeah, any stocks or options discussed today should not be taken as direct trading suggestions. Options involve risk, may not be suitable for all investors. Beginning of the presentation, I mentioned the 4 steps for those of you taking a trial. If you haven't done so yet, you don't need a credit card. Just go to powerop.com, put in your name and email address. You'll have full access to Power Options for 14 days. And the trial actually doesn't start until you first log in. So if something comes up and you can't access it, that's no problem. Even if you logged in a couple times, we'll gladly extend it for you if something comes up. The subscription levels, monthly subscription levels to Power Options after that trial start at $45 per month. We do have a real-time service and, of course, a historical service, which gives you access to the delayed data and all the tools we saw today with 15-20 minute delayed data and full access to our back testing tools and historical options data, which goes back to April of 2006. We talked about some of that education as well. At any time, you can go to blog.powerop.com. We saw the webinars page, powerop.com/webinars.asp. Click on that option strategies tab. You'll see my thoughts on trigger points and preferred ways to manage those various strategies, covered calls, naked puts, bull put credit spreads, regular spreads, and much, much more. Of course, you can always check out a lot of our Friday discussions and a lot of other videos directly on YouTube for free. YouTube.com user PowerOptions as well. Now, ladies and gentlemen, if you do think of any questions at any time during the weekend, during the week, whenever, remember, send me an email anytime to support@powerop.com. You can also reach me at support@radioactivetrading.com if you have questions about the married put, strategy, blueprint, or more. You can also reach us during market hours at 302-992-7971. And anyone who's on a trial or a subscription, remember, you can schedule one of those coaching sessions at any time. The link to schedule a coaching session is right next to that free webinars tab that was shown underneath the main home tab on your account. Just click free coaching. It'll take you to a schedule. Just pick a time that matches your convenience. Well, ladies and gentlemen, this week we did see some movement in the market, of course. We saw some volatility, which worked well for my hedge with the VIX calls. I know Sam had emailed me this week and said his UVXY positions worked out really well for him also. Hopefully next week we won't see as much volatility, unless, of course, you're in a volatility play, and then I hope you see all the volatility you want for further profits. But we'll be back next Friday to see how next week goes for us as well. Have a great weekend, ladies and gentlemen. We'll see you soon. Good night.